Hello and welcome. In this course, we will explore property, plant, and equipment based on International Accounting Standard 16. IAS 16, which covers property, plant, and equipment, was originally issued by the International Accounting Standards Committee in December 1993. In April 2001, the International Accounting Standards Board adopted the standard as part of its efforts to establish consistent global accounting practices. Before that, an earlier version of IAS 16, issued in March 1982, had already replaced certain provisions of IAS 4 on depreciation accounting, which had been in place since November 1975. Over time, these updates have helped refine the accounting treatment of tangible fixed assets, ensuring clarity and consistency in financial reporting. In 2017, with the issuance of IFRS 17 on insurance contracts, IAS 16 was amended to allow entities under specific circumstances to measure owner-occupied properties as if they were investment properties. This means that in certain cases, these properties can be measured at fair value through profit or loss, following the guidelines of IAS 40 on investment property. Further amendments were introduced in May 2020 when the board issued Property, Plant, and Equipment proceeds before intended use. This update prohibited companies from deducting proceeds from selling items produced while preparing an asset for its intended use from the asset's cost. Instead, such proceeds and related costs must be recognized separately in profit or loss, ensuring greater transparency in financial reporting. Over the years, several other standards have introduced minor consequential amendments to IAS 16. These include IFRS 13 on fair value measurement, issued in May 2011, which provided guidance on measuring fair value across different standards. The annual improvements to IFRSs for the 2009-2011 and 2010-2012 cycles, issued in May 2012 and December 2013 respectively, made further refinements. Additional updates came with IFRS 15 on revenue from contracts with customers in May 2014 and IFRS 16 on leases in January 2016. In March 2018, amendments were also made as part of the references to the conceptual framework in IFRS standards, ensuring consistency with the evolving principles of financial reporting. IAS 16, which covers property, plant, and equipment, is structured into 83 paragraphs along with an appendix. While all paragraphs hold equal authority, the standard maintains the original format established by the International Accounting Standards Committee before being adopted by the International Accounting Standards Board, IASB. To fully understand and apply IAS 16, it should be read in conjunction with its objective: the basis for conclusions, the preface to IFRS standards, and the conceptual framework for financial reporting. Additionally, IAS 8, which addresses accounting policies, changes in accounting estimates, and errors, serves as a reference for selecting and applying accounting policies when specific guidance is not provided within the standard. The purpose of IAS 16 is to establish the accounting treatment for property, plant, and equipment, ensuring that financial statement users can clearly understand an entity's investment in these assets and any changes over time. The standard addresses key aspects such as recognizing these assets, determining their carrying amounts, and accounting for depreciation and impairment losses. By providing a structured approach to these elements, IAS 16 enhances transparency and comparability in financial reporting. IAS 16 applies to the accounting treatment of property, plant, and equipment unless another standard requires or allows a different approach. However, there are specific exclusions from its scope. The standard does not apply to assets classified as held for sale, which are covered under IFRS 5 on non-current assets held for sale and discontinued operations. Additionally, biological assets related to agricultural activities are excluded, except for bearer plants, which fall under IAS 16. However, the produce growing on bearer plants remains outside its scope. IAS 16 does not apply to the recognition and measurement of exploration and evaluation assets, nor does it cover mineral rights and mineral reserves, including oil, natural gas, and other non-regenerative resources. However, the standard does apply to property, plant, and equipment used in the development or maintenance of these assets. Additionally, if an entity chooses to apply the cost model for investment property under IAS 40, it must also use the cost model outlined in IAS 16 for its owned investment property, ensuring consistency in financial reporting. In IAS 16, a bearer plant is defined as a living plant that is used in the production or supply of agricultural produce, is expected to bear produce for more than one period, and is unlikely to be sold as agricultural produce, except in cases of incidental scrap sales. This definition distinguishes bearer plants from other biological assets, ensuring that they are treated similarly to property, plant, and equipment for accounting purposes. The carrying amount of an asset is the value at which it is recorded in the financial statements after deducting any accumulated depreciation and impairment losses. This reflects the asset's net book value at a given point in time. The cost of an asset refers to the amount of cash or cash equivalents paid or the fair value of any other consideration given to acquire or construct the asset. In some cases, the initial recognition of an asset may follow specific IFRS requirements, such as IFRS 2 on share-based payment, where the attributed value may differ from the actual cash paid. The depreciable amount of an asset is calculated as its cost, or a substituted amount, minus its residual value. This represents the portion of the asset's value that will be allocated as an expense over time. Depreciation is the systematic process of distributing the depreciable amount of an asset over its useful life. This ensures that the asset's cost is recognized gradually in the financial statements, reflecting its consumption or wear and tear. Entity-specific value refers to the present value of the cash flows an entity expects to generate from the continued use of an asset and its eventual disposal. In the case of liabilities, it represents the cash outflows expected for settlement. Fair value is the price at which an asset can be sold, or a liability can be transferred in an orderly transaction between market participants on the measurement date. An impairment loss occurs when the carrying amount of an asset exceeds its recoverable amount. Property, plant, and equipment are tangible assets that an entity holds for purposes such as producing or supplying goods and services, renting to others, or administrative functions. These assets are expected to be used over multiple accounting periods, making them long-term investments in a business's operations. The recoverable amount of an asset is determined as the higher of its fair value minus disposal costs and its value in use. This ensures that assets are not carried in the financial statements at amounts higher than what they can realistically generate in value. The residual value of an asset represents the estimated amount an entity would receive if it were to dispose of the asset at the end of its useful life, after deducting any disposal costs. This value is determined based on the asset's expected condition at the end of its service period. Useful life refers to either the length of time an asset is expected to be available for use by an entity or the total number of production units or similar outputs the entity anticipates obtaining from the asset. This estimation helps determine the asset's depreciation over its lifetime. An item of property, plant, and equipment is recognized as an asset when it meets two key conditions. First, it must be probable that the asset will generate future economic benefits for the entity, and second, its cost must be measured reliably. Certain items, such as spare parts, standby equipment, and servicing equipment, are classified as property, plant, and equipment only if they meet the definition of such assets under this standard. Otherwise, they are recorded as inventory, reflecting their role in the business's operations. This standard does not define a specific unit of measure for recognizing property, plant, and equipment, meaning entities must use judgment to determine what qualifies as a separate asset. The recognition criteria should be applied based on the entity's specific circumstances. In some cases, it may be appropriate to group individually insignificant items such as molds, tools, and dies, and assess them collectively. This approach ensures that assets contributing to future economic benefits are properly recognized, even if their individual costs are not significant. An entity assesses all costs related to property, plant, and equipment at the time they are incurred, following the recognition principle. These costs include both the initial expenses of acquiring or constructing an asset and any subsequent costs for additions, replacements, or maintenance. Additionally, the cost of property, plant, and equipment may include expenses related to leased assets used in their construction or upkeep. For example, if a right-of-use asset under a lease is utilized in building or maintaining an item of property, plant, and equipment, its depreciation cost may be included in the asset's overall cost. Items of property, plant, and equipment may be acquired for reasons related to safety or environmental compliance. While these acquisitions may not directly increase the future economic benefits of a specific existing asset, they are often necessary for an entity to continue deriving economic benefits from other related assets. As a result, such items qualify for recognition as assets because they enable an entity to obtain future economic benefits that would otherwise not be possible without them. For example, a chemical manufacturing company may need to install new chemical handling processes to comply with environmental regulations governing the production and storage of hazardous chemicals. Although these processes do not directly increase production capacity or efficiency, they are essential for the company to continue its operations in compliance with legal and environmental standards. Without these enhancements, the entity would not be able to manufacture and sell chemicals. However, when recognizing such assets, it is important to assess whether their carrying amount remains appropriate over time. This means that the total value recorded for the asset and any related assets must be periodically reviewed for impairment, in accordance with IAS 36 impairment of assets, to ensure that the asset is not overstated in the financial statements. Under the recognition principle, an entity does not recognize in the carrying amount of an item of property, plant, and equipment the costs of the day-to-day servicing of the item. Rather, these costs are recognized in profit or loss as incurred. Costs of day-to-day servicing are primarily the costs of labor and consumables and may include the cost of small parts. The purpose of these expenditures is often described as for the repairs and maintenance of the item of property, plant, and equipment. Parts of some items of property, plant, and equipment may require replacement at regular intervals. For example, a furnace may require relining after a specified number of hours of use, or aircraft interiors such as seats and galleys may require replacement several times during the life of the airframe. Items of property, plant, and equipment may also be acquired to make a less frequently recurring replacement, such as replacing the interior walls of a building, or to make a non-recurring replacement. Under the recognition principle, an entity recognizes in the carrying amount of an item of property, plant, and equipment the cost of replacing part of such an item when that cost is incurred if the recognition criteria are met. The carrying amount of those parts that are replaced is derecognized in accordance with the derecognition provisions of this standard. A condition of continuing to operate an item of property, plant, and equipment, for example an aircraft, may be performing regular major inspections for faults regardless of whether parts of the item are replaced. When each major inspection is performed, its cost is recognized in the carrying amount of the item of property, plant, and equipment as a replacement if the recognition criteria are satisfied. Any remaining carrying amount of the cost of the previous inspection, as distinct from physical parts, is derecognized. This occurs regardless of whether the cost of the previous inspection was identified in the transaction in which the item was acquired or constructed. If necessary, the estimated cost of a future similar inspection may be used as an indication of what the cost of the existing inspection component was when the item was acquired or constructed. When an item of property, plant, and equipment qualifies for recognition as an asset, it must be measured at its cost. This cost includes all expenditures directly attributable to bringing the asset into working condition for its intended use. The cost of an item of property, plant, and equipment includes its purchase price, which encompasses any import duties and non-refundable taxes after deducting trade discounts and rebates. It also includes any costs that are directly attributable to bringing the asset to the location and condition necessary for it to operate in the way intended by management. Additionally, the cost comprises the initial estimate of the costs for dismantling and removing the item, as well as restoring the site where it is located. These obligations arise either when the item is acquired or as a result of using the item for purposes other than producing inventories during a particular period. Examples of directly attributable costs include employee benefits, costs directly arising from the construction or acquisition of the item of property, plant, and equipment, costs related to site preparation, initial delivery and handling costs, installation and assembly costs, costs associated with testing whether the asset is functioning properly, that is, assessing whether its technical and physical performance is suitable for its intended use, such as in the production or supply of goods, services, rental, or administrative purposes, and professional fees. An entity applies IAS 2 inventories to the costs of obligations for dismantling, removing, and restoring the site on which an item is located, incurred during a particular period as a consequence of having used the item to produce inventories. These obligations are recognized and measured in accordance with IAS 37 provisions, contingent liabilities, and contingent assets, whether the costs are accounted for under IAS 2 or IAS 16. Examples of costs that are not considered costs of an item of property, plant, and equipment include costs of opening a new facility, costs of introducing a new product or service, such as advertising and promotional activities, costs of conducting business in a new location or with a new class of customer, including staff training, and administration and other general overhead costs. Recognition of costs in the carrying amount of an item of property, plant, and equipment ceases when the item is in the location and condition necessary for it to operate in the manner intended by management. Consequently, costs incurred in using or redeploying the item are not included in the carrying amount. For instance, the following costs are not included in the carrying amount: costs incurred while an item, although capable of operating as intended by management, has not yet been brought into use or is operating at less than full capacity. Initial operating losses, such as those incurred while demand for the item's output builds up, and costs associated with relocating or reorganizing part or all of an entity's operations. Items may be produced while bringing an item of property, plant, and equipment to the location and condition necessary for it to operate in the manner intended by management, such as samples produced during testing to assess whether the asset is functioning properly. In such cases, the entity recognizes both the proceeds from selling these items and their cost in profit or loss in accordance with applicable standards. The cost of these items is measured by applying the measurement requirements of IAS 2. Some operations that occur in connection with the construction or development of an item of property, plant, and equipment are not necessary to bring the item to the location and condition needed for it to operate as intended by management. These incidental operations may take place before or during the construction or development process. For example, a building site may generate income by being used as a car park until construction begins. Since incidental operations are not required to bring the item to its intended location and condition, any income and related expenses from such operations are recognized in profit or loss and categorized within their respective classifications of income and expenses. The cost of a self-constructed asset is determined using the same principles as for an acquired asset. If an entity creates similar assets for sale in the ordinary course of business, the cost of the asset is generally the same as the cost of constructing an asset for sale, as outlined in IAS 2. Consequently, any internal profits are eliminated in determining the cost. Additionally, the cost of abnormal amounts of wasted materials, labor, or other resources incurred during the self-construction of an asset is not included in the asset's cost. IAS 23 borrowing cost sets out criteria for recognizing interest as part of the carrying amount of a self-constructed item of property, plant, and equipment. Bearer plants are accounted for in the same way as self-constructed items of property, plant, and equipment before they are in the location and condition necessary to operate as intended by management. Therefore, references to construction in this standard should be understood to include activities that are required to cultivate the bearer plants before they reach the location and condition necessary for their intended use. The cost of an item of property, plant, and equipment is determined by its cash price equivalent at the recognition date. If payment is deferred beyond normal credit terms, the difference between the cash price equivalent and the total payment is recognized as interest over the credit period, unless such interest is capitalized in accordance with IAS 23. When one or more items of property, plant, and equipment are acquired in exchange for a non-monetary asset or a combination of monetary and non-monetary assets, the cost of the acquired item is generally measured at fair value. However, this measurement applies only if the exchange transaction has commercial substance and the fair value of both the asset received and the asset given up is reliably measurable. If these conditions are not met, the cost of the acquired item is measured at the carrying amount of the asset given up. This principle holds even if the entity cannot immediately derecognize the asset given up. An entity determines whether an exchange transaction has commercial substance by assessing the extent to which its future cash flows are expected to change due to the transaction. A transaction is considered to have commercial substance if the configuration, risk, timing, and amount of the cash flows of the asset received differs from the configuration of the cash flows of the asset transferred, or if the entity-specific value of the portion of the entity's operations affected by the transaction changes as a result of the exchange. Additionally, the difference must be significant relative to the fair value of the assets exchanged. Essentially, the transaction must lead to a meaningful change in the entity's financial position or operations. For the purpose of determining whether an exchange transaction has commercial substance, the entity-specific value of the portion of the entity's operations affected by the transaction should reflect post-tax cash flows. The analysis of commercial substance may not require detailed calculations, as the result can be clear based on the circumstances. The fair value of an asset is considered reliably measurable if the variability in the range of reasonable fair value measurements is not significant for that asset, or if the probabilities of the various estimates within the range can be reasonably assessed and used when measuring fair value. If the fair value of either the asset received or the asset given up can be reliably measured, the fair value of the asset given up is used to measure the cost of the asset received unless the fair value of the asset received is more clearly evident. Additionally, the carrying amount of an item of property, plant, and equipment may be reduced by government grants in accordance with IAS 20, which covers the accounting for government grants and the disclosure of government assistance. Measurement after recognition requires an entity to choose either the cost model or the revaluation model as its accounting policy, and apply that policy consistently to an entire class of property, plant, and equipment. The cost model involves measuring the asset at its cost, less any accumulated depreciation and impairment losses. Under the revaluation model, the asset is measured at its fair value at the revaluation date, less any subsequent accumulated depreciation and impairment losses. Once a model is selected, it must be applied consistently across all assets within the same class, ensuring that similar assets are treated in the same way for accounting purposes. Entities that operate an investment fund or issue groups of insurance contracts with direct participation features and which include owner-occupied property apply IAS 16 to such properties. These properties may be measured using the fair value model, and this election allows the entity to treat owner-occupied property as a separate class of property, plant, and equipment. In doing so, the entity must apply the fair value model to these properties, ensuring they are distinguished from other assets within the entity. Though this treatment applies even if the owner-occupied properties are part of a fund or are underlying items in insurance contracts, which may include investment contracts with discretionary participation features. After recognition as an asset, an item of property, plant, and equipment is carried at its cost, less any accumulated depreciation and accumulated impairment losses. This means that the asset's value is reduced over time to reflect its usage and any impairment, with the initial cost being adjusted by these factors to represent its current carrying amount. After recognition as an asset, an item of property, plant, and equipment whose fair value can be measured reliably shall be carried at its revalued amount. This revalued amount is the fair value at the date of revaluation, less any subsequent accumulated depreciation and accumulated impairment losses. Revaluations must be carried out with sufficient regularity to ensure that the carrying amount does not differ materially from what would be determined using fair value at the end of the reporting period. The frequency of revaluations depends on the changes in the fair values of the items of property, plant, and equipment being revalued. If the fair value of a revalued asset differs materially from its carrying amount, a further revaluation is required. Some items of property, plant, and equipment experience significant and volatile changes in fair value, which may require annual revaluation. However, for items with only insignificant changes in fair value, revaluation may be needed only every 3 to 5 years. When an item of property, plant, and equipment is revalued, its carrying amount is adjusted to the revalued amount. At the date of revaluation, the asset is treated in a way that ensures consistency with the revaluation of the carrying amount. This can involve adjusting the gross carrying amount by referencing observable market data or proportionally to the change in the carrying amount. The accumulated depreciation at the date of revaluation is also adjusted to equal the difference between the gross carrying amount and the carrying amount of the asset, taking into account any accumulated impairment losses. When an item of property, plant, and equipment is revalued, the accumulated depreciation is eliminated against the gross carrying amount of the asset. The amount of this adjustment is included in the increase or decrease in carrying amount that is accounted for. If one item of property, plant, and equipment within a class is revalued, the entire class to which the asset belongs must be revalued. When an item of property, plant, and equipment is revalued, the accumulated depreciation is eliminated against the gross carrying amount of the asset. The amount of this adjustment is included in the increase or decrease in carrying amount that is accounted for. If one item of property, plant, and equipment within a class is revalued, the entire class to which the asset belongs must be revalued. Items within a class of property, plant, and equipment are typically revalued simultaneously to avoid selective revaluation of assets and the reporting of amounts that reflect a mixture of costs and values from different dates. However, a class of assets may be revalued on a rolling basis, provided that revaluation is completed within a short period and that the revaluations are kept up to date. If the carrying amount of an asset increases due to revaluation, the increase should be recognized in other comprehensive income and accumulated in equity under the heading of revaluation surplus. However, the increase is recognized in profit or loss to the extent that it reverses a revaluation decrease of the same asset that was previously recognized in profit or loss. If the carrying amount of an asset decreases as a result of a revaluation, the decrease should be recognized in profit or loss. However, if there is any credit balance existing in the revaluation surplus for that asset, the decrease should be recognized in other comprehensive income to the extent of the balance in the revaluation surplus. The decrease recognized in other comprehensive income will reduce the amount accumulated in equity under the heading of revaluation surplus. The revaluation surplus included in equity for an item of property, plant, and equipment can be transferred directly to retained earnings when the asset is derecognized, such as when it is retired or disposed of. In such cases, the entire surplus may be transferred. However, if the asset is still in use, only a portion of the surplus is transferred, typically the difference between depreciation based on the revalued carrying amount and depreciation based on the asset's original cost. Transfers from revaluation surplus to retained earnings are made directly and are not recognized through profit or loss. Additionally, any tax effects resulting from the revaluation of property, plant, and equipment should be recognized and disclosed accordingly. Each significant part of an item of property, plant, and equipment whose cost is material in relation to the total cost of the item must be depreciated separately. An entity should allocate the initial recognition amount of the item to its significant parts and depreciate each part independently. For example, it is common practice to depreciate the airframe and engines of an aircraft separately due to their significant cost. Similarly, if an entity acquires property, plant, and equipment under an operating lease as the lessor, it may be necessary to depreciate separately the amounts attributed to the favorable or unfavorable lease terms relative to market conditions. A significant part of an item of property, plant, and equipment may share the same useful life and depreciation method as another significant part of the same item. In such cases, these parts can be grouped together when determining the depreciation charge. If an entity depreciates some parts of the item separately, it must also depreciate the remaining parts separately. The remainder consists of parts that are not individually significant. If the entity has different expectations for these parts, it may need to use approximation techniques to ensure that the depreciation reflects the consumption pattern and/or useful life of the parts in a way that accurately represents their value over time. An entity may opt to depreciate the parts of an item that do not have a significant cost relative to the total cost of the item separately. The depreciation charge for each period should generally be recognized in profit or loss unless it is included in the carrying amount of another asset. Typically, depreciation is recorded as an expense in profit or loss, but in some cases, the future economic benefits from an asset are absorbed in the process of producing other assets. When this occurs, the depreciation charge becomes part of the cost of the other asset and is included in its carrying amount. For example, the depreciation of manufacturing plant and equipment is included in the cost of converting inventories. Similarly, depreciation on property, plant, and equipment used in development activities can be included in the cost of an intangible asset. The depreciable amount of an asset should be allocated systematically over its useful life. The residual value and useful life of an asset must be reviewed at least annually, typically at the end of the financial year. If the expectations differ from previous estimates, the change ZES should be treated as a change in accounting estimate in accordance with IAS 8, which addresses accounting policies, changes in accounting estimates, and errors. This ensures that the depreciation reflects the most current assumptions about the asset's future usage and value. Depreciation must be recognized even if the fair value of an asset exceeds its carrying amount, as long as the asset's residual value does not exceed its carrying amount. The need to depreciate an asset is not negated by repair and maintenance activities. The depreciable amount of an asset is determined by deducting its residual value from its cost. In many cases, the residual value is minimal and does not significantly affect the calculation of the depreciable amount. If the residual value of an asset increases to an amount equal to or greater than its carrying amount, the asset's depreciation charge becomes zero. This continues until the residual value decreases below the asset's carrying amount, at which point depreciation resumes. Depreciation of an asset starts when it is available for use, meaning it is in the necessary location and condition for operating as intended by management. Depreciation ceases at the earlier of two events: when the asset is classified as held for sale or part of a disposal group that is held for sale in accordance with IFRS 5, or when the asset is derecognized. Thus, depreciation does not stop if the asset becomes idle or is retired from active use, unless it is fully depreciated. However, in the case of usage-based depreciation methods, the depreciation charge can be zero if the asset is not being used, such as when there is no production. The future economic benefits embodied in an asset are primarily consumed by an entity through its use. However, other factors, such as technical or commercial obsolescence and wear and tear, while the asset remains idle, can also lead to a reduction in the economic benefits that might have been obtained from the asset. When determining the useful life of an asset, it is important to consider the expected usage of the asset, which is assessed by reference to the asset's expected capacity or physical output. Additionally, expected physical wear and tear plays a role, which depends on operational factors such as the number of shifts for which the asset is used, the repair and maintenance program, and the care and maintenance provided while the asset is idle. In addition to the factors mentioned, technical or commercial obsolescence can arise from changes or improvements in production methods or from shifts in market demand for the product or service produced by the asset. A reduction in the expected future selling price of an item produced by the asset might indicate the onset of technical or commercial obsolescence, signaling a potential decrease in the future economic benefits embodied in the asset. Another consideration in determining the useful life of an asset is the presence of legal or similar limits on its use, such as expiry dates of related leases, which could restrict its operational lifespan. The useful life of an asset is determined based on the expected utility it provides to the entity. The entity's asset management policy might involve disposing of assets after a certain period or once a specified proportion of the asset's future economic benefits have been consumed. As a result, the useful life of an asset may be shorter than its total economic life. Estimating the useful life of an asset is ultimately a judgment call, relying on the entity's experience with similar assets and their performance over time. Land and buildings are treated as separate assets and accounted for individually, even when acquired together. Generally, land has an indefinite useful life and is not subject to depreciation, with exceptions such as quarries and landfill sites. On the other hand, buildings have a finite useful life and are depreciated accordingly. The increase in the land's value does not affect the depreciable amount of the building. In cases where the cost of land includes expenses for site dismantling, removal, or restoration, this portion of the land is depreciated over the period during which these benefits are realized. In some instances, if the land itself has a limited useful life, depreciation is applied in a manner that reflects the benefits expected from its use. The depreciation method chosen should align with the pattern in which the asset's future economic benefits are expected to be consumed by the entity. This method must be reviewed at least at each financial year end. If there is a significant change in the anticipated pattern of consumption of the asset's future economic benefits, the depreciation method should be adjusted to reflect this change. Any such adjustment is considered a change in an accounting estimate and should be accounted for accordingly. A variety of depreciation methods can be used to allocate the depreciable amount of an asset systematically over its useful life. These methods include the straight line method, the diminishing balance method, and the units of production method. The straight line method results in a constant depreciation charge over the asset's useful life, provided its residual value remains unchanged. The diminishing balance method leads to a decreasing depreciation charge over time. The units of production method charges depreciation based on the expected use or output of the asset. The entity should select the method that most accurately reflects the expected pattern of consumption of the future economic benefits embodied in the asset. Once chosen, the selected method is applied consistently from period to period unless there is a change in the expected pattern of consumption of those future economic benefits. A depreciation method based on revenue generated by an activity involving the use of an asset is not appropriate. This is because revenue typically reflects factors unrelated to the consumption of the asset's economic benefits. For example, revenue can be influenced by other inputs, processes, selling activities, and fluctuations in sales volumes and prices. Additionally, the price component of revenue may be affected by inflation, which does not have an impact on how the asset is consumed. Therefore, using revenue as the basis for depreciation does not accurately reflect the asset's consumption of economic benefits. To determine whether an item of property, plant, and equipment is impaired, an entity applies IAS 36 impairment of assets. This standard outlines the process for reviewing the carrying amount of assets, determining their recoverable amount, and recognizing or reversing an impairment loss. It provides guidance on when an asset's carrying amount may exceed its recoverable amount, requiring a write-down, as well as the conditions under which previously recognized impairments can be reversed. Compensation from third parties for items of property, plant, and equipment that were impaired, lost, or given up should be recognized in profit or loss when the compensation becomes receivable. Impairments, losses, claims for compensation, and any subsequent purchases or constructions of replacement assets are distinct economic events and should be accounted for separately. Impairments of items of property, plant, and equipment are recognized in accordance with IAS 36. The derecognition of items of property, plant, and equipment that are retired or disposed of is determined according to the relevant standard. Compensation from third parties is included in profit or loss when it becomes receivable. Lastly, the cost of items of property, plant, and equipment that are restored, purchased, or constructed as replacements is determined in accordance with the applicable standard. The carrying amount of an item of property, plant, and equipment shall be derecognized either on disposal or when no future economic benefits are expected from its use or disposal. The gain or loss arising from the derecognition of an item of property, plant, and equipment shall be included in profit or loss when the item is derecognized, unless IFRS 16 leases requires otherwise on a sale and leaseback. It is important to note that gains shall not be classified as revenue. However, an entity that routinely sells items of property, plant, and equipment in the course of its ordinary activities, after holding them for rental to others, shall transfer such assets to inventories at their carrying amount when they cease to be rented and become held for sale. The proceeds from the sale of these assets shall be recognized as revenue in accordance with IFRS 15, revenue from contracts with customers. It is important to note that IFRS 5 does not apply when assets that are held for sale in the ordinary course of business are transferred to inventories. The disposal of an item of property, plant, and equipment can occur in various ways, such as by sale, entering into a finance lease, or donation. The date of disposal is determined by the point at which the recipient gains control of the asset, following the requirements for when a performance obligation is satisfied as outlined in IFRS 15. It is important to note that IFRS 16 applies to disposal transactions involving a sale and leaseback arrangement. When an entity recognizes the cost of a replacement for a part of an item of property, plant, and equipment in its carrying amount, it must recognize the carrying amount of the replaced part, even if the replaced part was depreciated separately. In cases where it is not practicable for an entity to determine the carrying amount of the replaced part, it may use the cost of the replacement as an indication of what the cost of the replaced part was at the time it was initially acquired or constructed. The gain or loss resulting from the derecognition of an item of property, plant, and equipment is determined by the difference between the net disposal proceeds, if any, and the carrying amount of the item. The consideration included in the gain or loss from derecognition is determined based on the requirements for determining the transaction price. If there are any subsequent changes to the estimated amount of the consideration, these changes are accounted for in accordance with the guidance for changes in the transaction price as outlined in IFRS 15. The financial statements should disclose for each class of property, plant, and equipment the measurement bases used for determining the gross carrying amount, the depreciation methods applied, the useful lives or depreciation rates used, and the gross carrying amount along with the accumulated depreciation aggregated with accumulated impairment losses at the beginning and end of the period. The financial statements should also include a reconciliation of the carrying amount at the beginning and end of the period, showing additions, assets classified as held for sale or included in a disposal group classified as held for sale in accordance with IFRS 5, and other disposals. It should also include acquisitions through business combinations and increases or decreases resulting from revaluations and impairment losses recognized or reversed in other comprehensive income in accordance with IAS 36. The reconciliation should also include impairment losses recognized in profit or loss, impairment losses reversed in profit or loss, depreciation, and the net exchange differences arising on the translation of financial statements from the functional currency into a different presentation currency, including the translation of a foreign operation into the presentation currency of the reporting entity. Additionally, it should reflect other changes. The financial statements should also disclose the existence and amounts of restrictions on title, along with property, plant, and equipment pledged as security for liabilities. Additionally, they should provide the amount of expenditures recognized in the carrying amount of an item of property, plant, and equipment during its construction, as well as the amount of contractual commitments for the acquisition of property, plant, and equipment. If not presented separately in the statement of comprehensive income, the financial statements should also disclose the amount of compensation from third parties for items of property, plant, and equipment that were impaired, lost, or given up, which is included in profit or loss. Additionally, the financial statements should disclose the amounts of proceeds and costs included in profit or loss that relate to items produced that are not an output of the entity's ordinary activities, specifying the line items in the statement of comprehensive income that include such proceeds and costs. The selection of the depreciation method and the estimation of the useful life of assets are matters of judgment. Consequently, disclosing the methods adopted, as well as the estimated useful lives or depreciation rates, provides users of financial statements with valuable information that allows them to evaluate the policies chosen by management and make comparisons with other entities. For similar reasons, it is essential to disclose the depreciation recognized during the period, whether in profit or loss, or as part of the cost of other assets, and the accumulated depreciation at the end of the period. In accordance with IAS 8, an entity is required to disclose the nature and effect of a change in an accounting estimate that impacts the current period or is expected to have an effect in subsequent periods. For property, plant, and equipment, such disclosures may arise from changes in estimates related to residual values, the estimated costs of dismantling, removing, or restoring items of property, plant, and equipment, useful lives, and depreciation methods. This ensures transparency in how changes in estimates affect the financial statements and provides users with the necessary information to understand the implications of those changes. If items of property, plant, and equipment are stated at revalued amounts, additional disclosures must be made in accordance with the requirements of IFRS 13. These disclosures include the effective date of the revaluation, whether an independent valuer was involved, and for each revalued class of property, plant, and equipment, the carrying amount that would have been recognized had the assets been carried under the cost model. Furthermore, the revaluation surplus must be disclosed, indicating the change for the period and any restrictions on the distribution of the balance to shareholders. These disclosures help provide transparency regarding the revaluation process and allow users to understand the impact on the entity's financial position. In accordance with IAS 36, an entity is required to disclose information on impaired property, plant, and equipment, in addition to the mandatory disclosures related to impairments. Users of financial statements may find it useful to have additional information, such as the carrying amount of temporarily idle property, plant, and equipment. This helps users assess the potential future use and value of such assets, providing a clearer picture of the entity's asset management and operational efficiency. The entity should also disclose the gross carrying amount of any fully depreciated property, plant, and equipment that is still in use, as well as the carrying amount of property, plant, and equipment that has been retired from active use but is not classified as held for sale in accordance with IFRS 5. Additionally, when the cost model is used, the fair value of property, plant, and equipment should be disclosed if it is materially different from the carrying amount. These disclosures are encouraged as they provide valuable insights into the entity's asset base, highlighting the potential need for future investment or reassessment of asset values. The requirements concerning the initial measurement of an item of property, plant, and equipment acquired through an exchange of assets transaction must be applied prospectively to future transactions only. Regarding amendments from the annual improvements to IFRS's 2010-2012 cycle, an entity must apply the amendment to all revaluations recognized in annual periods beginning on or after the date of initial application of the amendment, as well as in the immediately preceding annual period. While entities have the option to present adjusted comparative information for earlier periods, they are not obligated to do so. If unadjusted comparative information is presented for earlier periods, the entity must clearly identify this information, state that it has been presented on a different basis, and provide an explanation of that basis. When the amendments related to agriculture bearer plants to IAS 16 and IAS 41 are first applied, an entity is not required to disclose quantitative information for the current period. However, the entity must present quantitative information for each prior period presented. Additionally, an entity has the option to measure an item of bearer plants at its fair value at the beginning of the earliest period presented in the financial statements for the reporting period in which the amendments are first applied. This fair value can be used as the deemed cost at that date. Any difference between the previous carrying amount and the fair value should be recognized in opening retained earnings at the beginning of the earliest period presented. The Amendment Property, Plant, and Equipment Proceeds Before Intended Use, issued in May 2020, revised certain provisions and introduced new requirements. Entities must apply these amendments retrospectively, but only to items of property, plant, and equipment that have reached the location and condition necessary for operation as intended by management on or after the beginning of the earliest period presented in the financial statements when the entity first applies the amendments. The cumulative effect of initially applying the amendments should be recognized as an adjustment to the opening balance of retained earnings or another appropriate component of equity at the beginning of that earliest period presented. The standard shall be applied for annual periods beginning on or after the 1st of January 2005, with earlier application encouraged. If an entity applies the standard for a period beginning before the 1st of January 2005, it must disclose that fact. Additionally, the amendments in paragraph 3 shall be applied for annual periods beginning on or after the 1st of January 2006. If an entity applies IFRS 6 for an earlier period, those amendments must also be applied for that earlier period. IAS 1 presentation of financial statements, as revised in 2007, introduced changes in terminology and amendments to paragraphs 39, 40, and 73E IV. These amendments shall be applied for annual periods beginning on or after the 1st of January 2009. If an entity applies IAS 1, revised 2007, for an earlier period, the amendments must also be applied for that earlier period. Similarly, IFRS 3 business combinations, as revised in 2008, amended paragraph 44 with the amendment applying to annual periods beginning on or after the 1st of July 2009. If an entity applies IFRS 3, revised 2008, for an earlier period, the amendment shall also be applied for that earlier period. Paragraph 6 and 69 were amended, and paragraph 68A was added by improvements to IFRSs issued in May 2008. These amendments shall be applied for annual periods beginning on or after the 1st of January 2009, with earlier application permitted. If an entity applies these amendments for an earlier period, it must disclose that fact and simultaneously apply the related amendments to IAS 7 Statement of Cash Flows. Additionally, paragraph 5 was amended by improvements to IFRSs issued in May 2008, and this amendment shall be applied prospectively for annual periods beginning on or after the 1st of January 2009. Earlier application is permitted only if the entity also applies the amendments to paragraphs 8, 9, 22, 48, 53, 53A, 53B, 54, 57, and 85B of IAS 40 at the same time. If an entity applies the amendment for an earlier period, it must disclose that fact. IFRS 13, issued in May 2011, amended the definition of fair value and the definition of recoverable amount in paragraph 6, along with amendments to paragraphs 26, 35, and 77, while deleting paragraphs 32 and 33. An entity shall apply these amendments when it applies IFRS 13. Additionally, the Annual Improvements 2009-2011 cycle, issued in May 2012, amended paragraph 8. Entities shall apply this amendment retrospectively in accordance with IAS 8 accounting policies, changes in accounting estimates, and errors for annual periods beginning on or after the 1st of January 2013. Earlier application is permitted, provided that the entity discloses this fact if applied for an earlier period. The Annual Improvements to IFRS's 2010-2012 cycle, issued in December 2013, amended paragraph 35 and added paragraph 80A. Entities shall apply these amendments for annual periods beginning on or after the 1st of July 2014, with earlier application permitted. If an entity applies the amendment for an earlier period, it must disclose that fact. Additionally, the clarification of acceptable methods of depreciation and amortization, amendments to IAS 16 and IAS 38, issued in May 2014, amended paragraph 56 and added paragraph 62A. These amendments shall be applied prospectively for annual periods beginning on or after the 1st of January 2016. Earlier application is permitted, provided the entity discloses this fact if applied for an earlier period. IFRS 15, Revenue from Contracts with Customers, issued in May 2014, amended paragraphs 68A, 69, and 72. Entities shall apply these amendments when implementing IFRS 15. Additionally, agriculture, bearer plants, amendments to IAS 16 and IAS 41, issued in June 2014, amended paragraphs 3, 6, and 37 and introduced paragraphs 22A and 80B ADC. These amendments shall be applied for annual periods beginning on or after the 1st of January 2016, with earlier application permitted. If an entity applies the amendments for an earlier period, it must disclose that fact. The amendments shall be applied retrospectively in accordance with IAS 8, except as specified in paragraph 80C. IFRS 16, issued in January 2016, deleted paragraphs 4 and 27 while amending paragraphs 5, 10, 44, and 68 and 69. Entities shall apply these amendments when implementing IFRS 16. Similarly, IFRS 17, issued in May 2017, introduced paragraphs 29A and 29B, which must be applied in conjunction with IFRS 17. Furthermore, Property, Plant, and Equipment, Proceeds Before Intended Use, issued in May 2020, amended paragraphs 17 and 74 and added paragraphs 20A, 74A, and 80D. These amendments shall be applied for annual reporting periods beginning on or after the 1st of January 2022, with earlier application permitted. If an entity applies these amendments for an earlier period, it must disclose that fact. This standard supersedes IAS 16 Property, Plant, and Equipment, revised in 1998. Additionally, it replaces the following interpretations: SIC 6 costs of modifying existing software, SIC 14 Property, Plant, and Equipment, compensation for the impairment or loss of items, and SIC 23 Property, Plant, and Equipment, major inspection or overhaul costs. The amendments in this appendix shall be applied for annual periods beginning on or after the 1st of January 2005. If an entity applies the standard for an earlier period, these amendments shall also be applied for that earlier period. The amendments contained in this appendix, as issued in 2003, have been incorporated into the relevant pronouncements published in this volume. International Accounting Standard 16, Property, Plant, and Equipment, as revised in 2003, was approved for issue by the 14 members of the International Accounting Standards Board in December 2003. The members who approved this standard were Sir David Tweedy, Thomas E., Jones Mary E., Barth Hans-Georg Bruns Anthony T., Cope Robert P., Garnett Gilbert Gallard James J., Leisenring Warren J., McGregor Patricia L., O'Malley Harry K., Schmid John T., Smith Jeffrey Whittington, and Tatsumi Yamada. The clarification of acceptable methods of depreciation and amortization, amendments to IAS 16 and IAS 38, issued in May 2014, was approved for issue by 15 of the 16 members of the International Accounting Standards Board. Ms. Tokar dissented, and her dissenting opinion is provided after the basis for conclusions. The members who approved the amendments were Hans Hugervorst, Ian McIntosh, Stephen Cooper, Philippe Danjou, Martin Edelman, Jan Engstrom, Patrick Finnegan, Amaro Luis de Oliveira Gomez, Gary Kabarek, Suzanne Lloyd, Patricia McConnell, Takatsugu Ochi, Daryl Scott, Chungwoo Su, and Weiguo Zhang. The Agriculture Bearer Plants amendments to IAS 16 and IAS 41, issued in June 2014, was approved for issue by 14 of the 16 members of the International Accounting Standards Board. Mr. Finnegan and Ms. McConnell voted against its publication, and their dissenting opinions are provided after the basis for conclusions. The members who approved the amendments were Hans Hugervorst, Ian McIntosh, Stephen Cooper, Philippe Danjou, Martin Edelman, Jan Engstrom, Amaro Luis de Oliveira Gomez, Gary Kabarek, Suzanne Lloyd, Takatsugu Ochi, Daryl Scott, Chungwoo Su, Mary Tokar, and Weiguo Zhang. The Property, Plant, and Equipment, Proceeds Before Intended Use, which amended IAS 16, was approved for issue by all 14 members of the International Accounting Standards Board. The members who approved the amendments were Hans Hugervorst, Suzanne Lloyd, Nick Anderson, Taju Sendon, Martin Edelman, Francoise Flores, Gary Kaburek, Jean Kalu, Daryl Scott, Thomas Scott, Chungwoo Su, Rika Suzuki, Antarka, and Mary Takar. Thank you for completing our course and for the attention and dedication you've shown throughout. We are happy to have contributed to your professional development and encourage you to help us improve by providing your feedback. If you have any questions or suggestions, feel free to reach out via email at info@qlever.al or through the contact forms on our website. Also, we invite you to follow us on social media and our YouTube channel to stay updated on upcoming training sessions. Thank you once again, and we look forward to seeing you in our future courses.